Welcome to the Net Profit Podcast with Ryan Kibler, your net profit CFO, helping business owners like you grow their net profit one episode at a time. And now your host, Ryan Kibler.
Well, hello and welcome to another episode of the Net Profit Podcast. I'm your host, Ryan Kibler, the Net Profit CFO. Today, I have Mark Dolfini back with me. Mark was actually on the show, episode 127, and we talked about his Viper methodology and how he uses that to coach and work with business owners in his business, the Strategic Boardroom. Mark, thank you so much for taking the time and coming on the show again.
Man, anytime I get to geek out on financials, you don't need to thank me. I want to thank you. This is my jam.
Yes.
I don't get to enjoy the accounting side as much as I used to. Again, accounting's in my blood. I enjoy it. But it's good to be back, and thanks for having me.
Love it. Yes. So as Mark alluded to, today we are going to start a little bit of a series. I'm sure this is going to go more than one episode long, but Mark has that accounting finance background the same way that I do. And today I've actually just brought an example company to the table. If you're listening just audio wise, I would highly recommend, you're going to get a lot of it out of the audio, but highly recommend go check this out on YouTube. Really watch the video so you can see the numbers along with us. We're sharing screen here, and we're going to break down some financials, hopefully make it simple, easy, straightforward, the best that we can. Mark and I both know that sometimes accounting can be like speaking Chinese. So we are going to try to translate the best that we can. And hopefully you guys get some good content out of this and learn something. And we're going to break down these financials. All right. So Mark, any place in particular you want to start? I mean, I've got balance sheet, profit and loss here, but any place in particular you want to start to go in and break this down?
Yeah. So what we're seeing on the screen here is, and this is a fictional company, just to let you know, Ryan's not giving away.
Yes.
It's probably a composite, if I had to guess, because I did the same thing anytime I do any sort of training. I never, ever, ever put out anybody's stuff out there. So Henry's HVAC is not a real company. Doesn't represent any real company. Any similarity may be unintentional, et cetera, right?
Yep.
But the first thing, I love the fact, first and foremost, that you have the balance sheet up first. Because many business owners, as you and I both know, what's the first thing they go stampeding towards? They're looking at the income statement, right? Profit and loss. They're looking at the P&L and they're saying, oh my gosh, what is this, right? And just for the layman, right? Income statement, profit and loss, P&L, they are all the same thing. It's just different verbiage, but different vernacular. But the fact that you have this up, and for those of you who are not really accounting folks, and you're like, oh my gosh, numbers freak me out. Look, it's just about rules. So if you understand solitaire, you understand Monopoly, you understand the rules of the game, it's the same thing. It's just don't be freaked out by the numbers. But what I like that you have up here, Ryan, is that you have what I would call is a 1231.
Yep.
You have a 1231 for 3 years running.
Yep.
And I think that's brilliant because you get to see from column to column the trend of what was cash at the end of 2022, what was cash at the end of 23, what was cash at the end of 24. So you're starting to see that trend, and ideally you want to see that trend. For me, I always like to see the cash balances increasing. I want to see those cash balances because that becomes kind of the de facto insurance policy when things go sideways. Not if, but things will go sideways. That's the nature of business. So I love the fact that you have this in 3 columns and that you're starting with the balance sheet.
Yeah, for sure. I'm with you, right? Looking at trends, and if you have not, if you have a company and you haven't aligned at least 2 years, right? Go back and look at the last 2 years. Ask that from your accountant. And one other thing I'll point out is, yes, I have this set up at year end. You could also do any other month, right? You could do October 31st and October 31st. We're recording this beginning of November. Go back and just look historically at what did my balance sheet, what was my business picture a year ago, right? Really, really important. And just kind of looking at the trends, and it's easy to see, am I up or am I down, right? We can dive into the whys later, how you got those results, but at least just seeing first and becoming aware of, am I up or am I down?
Right. And obviously the assets are what you own in the business. The liabilities are what you owe out. And then obviously the difference between the two is your equity. So What Ryan has it laid out here is what's following GAAP, GAAP, right? Generally accepted accounting principles. And you've got the more liquid assets up at the top, which is your cash, your cash balances in your checking account. Could be cash balances in a petty cash box, right? But it's your total cash balances. And I love that you've got accounts receivable, which is what people owe you, right? That's the amount of it's sales that are basically uncollected, right, at this point. And you've got that starting in 2022. And if you're looking at the screen, you see it starts at 40,000, it goes to 65,000. Then of course it tops out at 145 on the 12/31 on 2024. And this is, keep in mind, the balance sheet is a snapshot in time. So it's the end of the period, whatever you're looking at.
Yep. Yeah.
So
I just want to add in there too, this is work that's been done already.
right.
If this is a heating and air business, let's say, they have an install full system that's supposed to go in next week that has not been billed yet. The work's not been done, or maybe it's been billed. Maybe you've given a quote and an invoice to a customer, but the work's not been done yet.
Right.
That would not be added into this balance.
That's a great point to make. Yeah.
Yeah. This balance is specifically work that you've billed and you've already completed, and you are waiting on the customer payment to come back in. And so, this is really money that you really need to keep an eye on and get out there and go collect if you need to.
Yeah. Probably in another session of these, we can show them, something called an AR aging report, right? Which is going to show the individual people that owe money. And this is really typical. I don't know that HVAC would see this super often, but I can definitely tell you other contractors see this, and especially with insurance work, where you're waiting for the insurance company to cut you a check, and you have to stay on top of them, man. I mean, you have to be on them like a Band-Aid, because they will conveniently forget you. And if you're not the one, greasing up the phone lines, you might have a $18,000-$20,000 HVAC system out there that never gets paid for just because you forgot about it. And the insurance companies, they're just not great at getting money out very timely.
Yep. Very true. Yeah. Very true.
So yeah, this is really good stuff. So obviously this is really important. The balance sheet shows the health of the company. If we scroll down just a little bit and show the liabilities of the company, we're looking at the total liabilities here.
Yep.
So you've got total liabilities, which are about pretty stable, right? So you're not seeing long-term liabilities get crazy. You're actually seeing the debt went up a little bit from 22 to 23, but then it went down a little bit in 24. So it's stable, and I think that's good. It shows that the total equity of the business is actually growing, which again, this is all based on book values, but it's good. Yeah, it's not all that unusual that I would see in a reasonably healthy but small HVAC company.
Yeah, and let's talk about, just the term liability for a minute, right? This is, you mentioned it earlier, you mentioned it kind of fast, and it was thrown in the middle of a sentence, and I just want to make sure, my listeners and viewers are picking up on this.
Right.
This is what the company owes, right? And to me and you, this is, easy. This is our language, right? But this is what the company owes to other parties and to other vendors. And kind of like up here at the top where we list assets, we list them in order of how fast can you turn them into cash, right? And so that's why cash obviously starts at the top.
Great point.
So with the liabilities, we list them in order of what should really be paid first, right? And so your accounts payable is probably bills that you get that's got to be due in the next 30 days. Current liabilities could be like a line of credit that you pay monthly ongoing that you're working on paying down the debt on, or maybe you're drawing on and using. And then your total liabilities, your long-term liabilities that are also in here, that could be something like maybe buying a building or having some equipment that's 5, 7, 10, 20-year financing.
Right.
So again, liabilities is what you owe, and we list them in order of the order that they're going to be paid out.
Yeah, that's such a great point. And I'm glad that you pulled me into neutral on that, because one of the things that I do see here quite often, and I know you see this as well, is business owners tend to use their own private credit cards in business often.
Yep.
Right. And I'm interested actually in your take on this, Ryan. So what I suggest is that if you do, because I get it, let's face it, it's small business, right?
Yeah.
But the thing is, so I have several cards that are personally in my name, and I use only for Strategic Boardroom. I buy only through Strategic Boardroom. And let's face it, because if I'm paying, 40 grand, and my expenses aren't that high in my Strategic Boardroom, but let's look at my property management company, for example. If I'm running 50 or $60,000 a month through bills through my credit cards, that's a substantial amount of points that I get the benefit of, right? Which
Yep.
right now I don't think the government has figured out how to tax those, but I'm sure that's coming.
Yep.
But the thing is, like, that's basically free money. So if I was looking at this from a true balance sheet perspective, that is where a credit card would go. Even though it's in my personal name, I would put that under other current liabilities because that is a short-term liability. Ryan, what is your stance on that?
Yeah, I think that's fair. I think that's reasonable. And, I don't mind if you're going to use personal cards, right? And then I assume, just so that I'm asking, just so that we're clear. So you use the personal card, let's say you put 50 on it. I assume then you're reimbursing yourself for that 50 to make the payment. Is that how that looks?
Yeah, so and this is where it gets a little murky, right? Because this is where you could pierce corporate veils and things like that.
Yep.
So, but the reality is this is how a lot of people do business. And I'm not suggest this is where you really need to talk to an attorney about this because you do want to make sure that if you have the protections of an LLC, that's the whole point of having an LLC, right? So it protects your personal assets from any sort of trickery that may go on. Or if God forbid, something you did in the business, then they can't attach to your personal assets.
Yep.
There may be a piercing of the corporate veil there if it's not done appropriately. So basically, the way it should be done is that basically, in essence, if let's say you charge up $50,000 on a personal credit card, that in essence becomes a loan to the business,
Yep.
right? And then that loan should be paid off to you. So you, the person, right? So let's say it's Mark Dolfini loaning the business the money, right, through the credit card.
Yep.
Then that loan gets paid back at the end of that month, right? So that is a way to keep that nice and clean. So and there's a way to do that. We're not going to get into the nuts and bolts. This is why you have to hire a guy like Ryan to keep you compliant, right? But that's the sort of thing that happens all the time. But when you do use that, and here's where the real problem comes in is when you start using that personal card for personal things and business things, that's when it gets really, really murky
Yep.
because and especially if you're paying that card with business funds that were specifically and very clearly personal expenses, that's when you pierce that corporate veil. Now, is there a way to get around that? Yeah. Just you'd have to take a distribution for the amount, or a salary for the amount or whatever for your personal stuff, right? Keeping that separate. There's a way to do it. It's just that it starts to murky the water. So I get it. Now the way that I do it now is I have corporate cards for each business. That way it keeps it nice and separated. American Express has been wonderful to work with from my perspective, but make sure it's an actual business card that it's not being reported to your personal credit because then it keeps it nice and separated.
Yes. Yeah, I love that. I think that so the best that you can, right, is just have dedicated cards, right?
Right. Yeah.
Either business or personal and keep them that way, the best that you can.
Yep.
And then, yes, I agree with you. Anything that's outstanding, that your intention is you're paying it, very, very soon, definitely current liabilities. The only other option that you really have would be if you're paying it and you're saying, well, I'm going to pay myself back over several years. And that
Right.
would be like giving a loan to your own business, and that you could maybe get into long-term liabilities, but the IRS also has rules about you have to accumulate real interest.
Yep.
So that makes things a lot more complex and you get into a lot of other things there if you start doing that.
Right. And this is why, again, like if you're doing your own accounting, I mean, you're okay in the beginning. Everybody does it. Let's face it, I have an accounting degree.
Yeah.
And I'm
Yeah.
the least qualified person to do my books because I know I'm not going to do it, right?
Yep.
So I'm going to do what everybody else does. I log into check my bank account in the morning, go, whew, I got money in my bank account, right?
Yep.
And cool. And at the end of the month, cool, I got more money in my bank account this month than last month. I must be doing okay. But you can't operate for that way for very long. So that's why, again, I'm promoting Ryan on this call because this is why you need someone like him, or just someone just at least handle the books. If it's not Ryan, but someone to at least handle the bookkeeping, just so you can make good choices and know that the books are getting reconciled. And when there are, let's face it, I pulled out the wrong card and used it like, oh man, shoot, I paid for my kids' dental appointment, using the company card, didn't think of it, right? I just pulled that out of habit. Like that stuff happens. But, just making sure that the transaction is coded properly, meaning that it's put in the right spot on the chart of accounts, and then it's handled appropriately. So you just got to make sure that that sort of stuff is good. Again, we're not giving legal advice here or even accounting advice. This is why you need your own people. But this is why I'm saying, like, I do recognize that people do this, but to Ryan's point, having those separate segregated cards just for that is exactly why you want to do that. It keeps things nice and clean.
Yep, for sure.
Want to take a look at the income statement?
Yeah, let's talk about equity for a minute though.
Oh, okay. Okay.
Before we do, let's go there first. So equity, I think you probably have a simpler definition than me. So I'll let you go first and kind of share with the audience, talk to the audience about equity.
Yeah. So I have kind of like a love-hate relationship with equity because from a small business perspective, I try not to get too hung up on this. Now, I am a heavy real estate kind of guy. So for me, equity means more than it might mean to someone who is like Henry here, who's got this HVAC company, because my equity is a heck of a lot more translatable into actual dollars because from a balance sheet perspective, again, what we're looking at here is assets minus liabilities equals the equity. Now, here's where it gets a little wonky, is that following generally accepted accounting principles, which is called GAAP, generally those assets are going to be listed at book value. Now, it doesn't mean Kelly Blue book value. It means like, what is the purchase price? So if we bought that, let's say I bought a property for, $2.5 million, that's going to sit on my balance sheet at 2.5 million, right? And then it's going to be accumulated depreciation and all that. But unless it's marked to market, it's got its own issues there.
More rare. Yeah.
More rare, exactly. But it generally is going to sit on there for 2.5 million, even if I own the property for a number of years. So this is where it starts to get a little bit wonky. That's on one side. On the other end of the equation, let's say I don't have a lot of assets in a business, or most of the assets are accounts receivable, their inventory, like I've got a stock of outside condensing units. So again, let's say it's an HVAC company or air handlers or whatever, those things age out, right? They're not they don't hold the same value over time, right? And they definitely don't appreciate. So this is where the equity for a service type company gets a little bit more wonky. So I don't know if I made things more clear or more confusing, but
no, I think
I'd love
good.
to hear your component to it, your aspect.
Yeah. I mean, so when you break it down, when it comes down to it, right, it's what you own minus what you owe, right? I think you had said that before, and that's real simple, straightforward, right? But I want to articulate what you just said a little bit more, and let's use an example of a house, right? And let's just make it easy, round numbers. You buy a house today for $500K, you put a loan on it for $400K. The difference there and what's left is what your equity is, right? That probably a lot of people relate to as home equity, right? And that would be $100K. But to your point, let's say you own that house for 5 years, the likelihood that house is worth $500K, if you're assuming you're taking care of it, right? You're not damaging it. The likelihood that it's still only worth $500K, probably very minimal, right? Because we all know that the cost of things goes up.
Right.
And so now on the reverse side of that, let's talk about buying like a van or a truck for Henry's Heating and Air. Let's say they go out and just buy a brand new van, one of those, just work vans that you deck out on the inside with tools and stuff like that. Let's just say that they bought it for 50, they put a loan on it for 40. Fast forward 5 years, we all know that it's not going to be worth 50. It's actually going to be worth less. Right. And so I agree with you. This is where equity can get really, really, really tricky. And hopefully, if you do go out and make that van purchase, hopefully you're paying down the loan faster than it's depreciating. But that can be on the car, right? Or on the van.
Right.
But that can be a battle too. And so it is very, very tricky. And when you look at this total equity number, what does it really mean for a business owner, right? Obviously, I think it's important. We don't want to see negative equity there, but there are some circumstances where you're going to have negative equity, and that's not necessarily a bad thing. So this number, it's really, really tricky. To me, this might be the most tricky number on the balance sheet.
Yeah, I would agree with that. So back in my former life, I was a credit analyst for the commercial lending department of a bank. And this is the sort of stuff that we would look at all the time. And it can also be not a great thing. Like you have to keep in mind, we would look at companies like as a great example. I always bought used vehicles for my property management company. Okay, now the property management company never owned anything. It actually owned like a printer and a landscape trailer, right? Because that was where all the contracts were entered through. So I had a shell company that owned the vehicles. Well, the vehicles, they were, these are $3,000-$4,000 vehicles. They were disposable. Like at some point we just knew we were gonna, metaphorically crumple them into a ball and throw them in the dumpster and go get another one, right? Because we
Yep.
knew that they were lower but we got so much value from those $3,000 and $4,000 vehicles that this is where it can get tricky that sometimes I see like around town here we see these contractors that are rolling around in a dually that's a $95,000 vehicle and I'm like holy moly, like that's a lot of money sitting in a vehicle.
Yep.
So it makes me wonder, like, okay, that makes me think that I look at them and go, wow, they must be doing well. And I'm thinking, but man, you've got a lot of money tied up in a depreciating asset. So I'm looking at it to say, I like having vans. They need to look right. They don't need to be all rusted out fenders and stuff like that. Like they need to look well, right? But assuming that if I bought a vehicle that was 5 years old, already had 125,000 miles on it, had been well maintained, but I got it for 15K, and I'm able to squeeze as much juice out of that lemon as I possibly can. Now I'm operating much more efficiently with depreciation and declining assets. So as a result, though, my balance sheet would look horrible,
Yeah.
right? But I can do more with declining assets. Maybe that's the Marine Corps in me. We're just
Yeah.
used to doing so much more with less. But that to me, I look at that as much more effective use of assets, especially with declining assets, something like, with something especially like vehicles. Because I'm telling you, it's real nice to be rolling around and being seen, in nice new vehicles and everything else. But man, that's a very slippery slope when you have real expensive assets. And again, your balance sheet might look amazing, but that doesn't show me the return on assets or return on equity that I necessarily would want to be getting.
For sure. For sure. Yeah. Well, if you have been following along, highly, highly recommend rewind the last 20 minutes, right? Go through, like, seriously, Mark and I will both tell you this balance sheet section, super, super, super important,
Yep.
way overlooked by not just business owners, but also accountants.
Yep.
Way, way, way overlooked. Rewind it. Please listen to it a second time. We're going to go to the income statement next. But again, just really try to get a good grasp on balance sheet.
Yep. I would
All
agree.
right, let's talk income statement. So I'll start basic definition, revenue or sales, right? And then we subtract out all of our expenses, and the end row we get down to is net profit, right? Probably this statement much more familiar to a lot of business owners, but that is really the easiest high level overview summary I could give. All the dollars that are coming in minus all of our expenses, direct and indirect, which we'll get to next, gets down to your net income, which really comes from the operations of your business. Mark, anything you want to add there before we dive into some numbers here?
No, this is great. And this is a really good basic income statement. Again, it's just about rules. If you can handle a four-function calculator, add, subtract, multiply, and divide, and I will tell you, you hardly ever even have to use the divide.
Yep.
So I think this is really what's understanding. So you're taking the revenue. Now, why don't you, from this perspective, why don't we define what cost of sales actually means? Because I think people get hung up on that a little bit, where if you're looking at an income statement or P&L, whatever you want to call it, in this case, we're both accounting purists here. So Ryan
Yeah.
correctly called it an income statement.
Yeah.
But let's say that we're looking at this income statement and you've got this cost of sales. What specifically, given Ryan, given, Henry's heating and air, what would you expect to be making up that cost of sales?
Yes, great question. Love that you asked me because I have a far different definition actually than the typical accounting one. Through my experience, I look at this way different. So
Sure.
traditionally with accounting, cost of sales was really made for businesses, in my opinion, that buy a product, right? Or buy parts and they have an inventory and then they sell it. And so their cost of sales was, well, what does it take to buy the widget, right? What does it take to buy product A, that we turn around and sell? And so today, when I work with my clients, I think what gives a business owner more insight is let's attribute anything that we can attribute directly to making sales. Let's put in cost of sales,
Okay.
right? And so, for a heating and air company, I mean, this could be directly heating and air parts. That would certainly make sense. You go out
Sure.
and buy a blower motor for somebody to replace it. That cost would be in cost of sales. It could also be contract labor, right? Which in the old terms of accounting would never get into cost of sales.
Yep.
You could certainly put in contract labor. And then another category that I'm going to throw out that's probably makes things, I think at times can bring some clarity, but it's kind of out of left field would be if you're doing like Google pay-per-click advertising,
Yeah.
right?
Marketing. Yep.
Yeah, I mean that marketing and advertising directly goes into your next sale. And so I could make the argument that from a management standpoint to really have some clarity that marketing and advertising could go in cost of sales, which again from a traditional accounting standpoint would have never gotten in cost of sales, right?
Right. Yeah. Yeah. I think that's really smart because I think now let's be clear. One of the things that I like to say is when in doubt, break it out. And Ryan knows exactly where I'm going with this. So if it's cost of sales, and let's just say he just named four different categories, four different subcategories of cost of goods sales. So, one of the subcategories was contract labor. One of the subcategories was inventory, right? Or,
Or
basically raw
parts.
materials,
Yeah.
right? Yeah, yeah,
Yep.
parts, raw materials, things like that. Like again, in Henry's HVAC system, that would be the 2.5 ton outside condensing unit that you've got three or four of them sitting in your shop, right? That are ready to be sold. You got five or six train air handlers, right? That are sitting in your shop getting ready to be sold. So those would be inventory items that are getting ready. And you might have 1,000 of copper tubing, things that, for your line sets, things like this. And that is where that would all be part of that cost of sales. But it doesn't mean just because you're putting that all in there, it doesn't mean that you just mix it up and forget it. You can, what a guy like Ryan would do is, and what I would do if I was looking at this as an analyst, is I'd want to break those out where you could look and say, okay, what's under the cost of sales? Oh, there's four categories under cost of sales. And the reason for that is because and we didn't really, and this is definitely worth maybe on another call, is where we start to look at percentages. That we look at these as a percentage of sales to say, oh, okay, well, cost of sales, based on this is 14% versus the next season it was 23%. Why did it go up so much? Right? Well, did the cost of copper go up? Well, if you're paying attention to right now what copper is doing in the market, yeah, copper is very expensive right now
Yep.
compared to what it was. So these are the sorts of things that are really good. And I love the fact, really quick, that you made the point about marketing expense because that so gets overlooked. And I like to look at marketing expense almost like an asset. Like, what's my RMI? What's my return on marketing investment? Because if I sent out 10,000 little Marines, right, and I want each one of them to bring back, five under each arm as they come back, right, that tells me, like, okay, great. Now I know that for every 10,000 I spend, they're going to be bringing back 50. That to me is a really important metric to track.
For sure. And I'll go to the percentages here real quick
Sure.
because I do actually have that here. So
I love it.
this big slide right here, these are the same numbers, right? So 598, 543. If I flip back to my actuals, 598, 543.
Okay, perfect. Yep.
So, Mark, to your point, as you had mentioned, right? Not only are we increasing in dollars here, but we are increasing as a percentage. Now, assuming that everything was consistent that we're putting in this category, right? That means our cost went up and we didn't raise our prices enough to keep
Right.
up with that, right? And where this can really make an impact is down here on the bottom where I have average gross profit. These are the dollars that you have to pay your other bills that you have, right?
Mm-hmm.
This is what's left over. Like I'm talking about if you're a heating and air company and let's say you rent a space, say you rent a building, I'm talking about what you have to pay rent. Maybe you have people on staff, it's what you have to pay payroll. Maybe you have other general marketing that's not directly correlated with like a pay per click. Maybe it's, maybe you do SEO or something like that that's general that you can't really directly tie to sales. These are the dollars that you're going to use in order to pay those bills. And, you can really see here 85% versus 92. Obviously, it's better to have 92% of what you're billing to pay bills versus
Right.
the 85.
Yeah, and this shows what you're demonstrating here is how efficient is the company at keeping dollars, right? How efficient are you at keeping dollars? And that's the thing that I love that you're showing here is yeah, from year A to year B, sales have declined, right? So that my mental math here, you got 599,000 roughly in year A to 543,000 in year B, right? So that's a decline of $56,000 from year A to year B in sales. But the thing is, your gross profit is significantly more of a decline, right? You're looking at, what is that, roughly 110,000 in gross profit and decline.
Yep.
So you're not only making less money, you're less efficient at keeping money. So that's the thing when you're looking at your cost of goods sales. So that's why I like to look at this as your cost of goods sales as a percentage of sales. So that way, if your sales are going up, and let's face it, this is exactly how you start to measure efficiency is
Yep.
because let's face it, has anybody ever come to you as a boss and said, you know what, boss, I just think you're paying me way too much. I really need you to go ahead and just start, can you just go ahead and knock my payroll down by 10%. That'd be great for me, right? No one in the history of ever, right?
Yep.
So they're always going to want raises. And the thing is, you got to be careful about giving raises that are going to outpace your growth in sales, right? Or your cost of goods sold. And this is the thing that most bosses that I know are just awesome people. They really want to take care of their people. And of course, they want to put money and throw, far and away, that's more the conversation than any other thing.
Yep.
And that's great. But the problem is what they're doing is they're creating a future problem by paying them out of revenues that they haven't earned yet. And they're diminishing. And they're really, this is a situation that we're not showing it here, but again, on another call, we talked about growing broke, where if the revenues are growing, but the revenues are growing faster than the ability for that company to maintain its cash position or to grow and keep its cash position. And that is how a company can easily grow broke. Now, in this case, it's not growing, it's actually declining, but they're less efficient at keeping the dollars that they actually have.
For sure. Yes, completely agree with that. So if I flip back here, so we have our gross profit right now. Just want to highlight here again, accounting terms, we didn't really make it easy on business owners. You have a gross profit and then you
Right.
have a net profit, right? So gross profit, we are just talking about what did you keep after your cost of sales. Net profit, we are talking about what did you keep after all expenses, right?
Sure.
So it's definitely possible here, and I just want to illustrate this real quick. Definitely possible here to have a gross profit and have a net loss,
Yep.
right? So here we have $152,000 in net profits. If I change this payroll, let's just say 480 and add, another 200,000 here, and say make this, about that would be 520-ish or 530. Now we have a net loss. So again, you can have a gross profit and you can have a net loss. So just want to highlight that for folks real quick. That's not what we have here. Here's the original numbers, but two different things.
Right. Right.
So
Yeah.
go
And
ahead.
it's easy to get drunk on the fact that, let's face it, especially companies this small that are at $500,000 in revenue, this is probably one guy in a truck, right? This is probably more likely one guy in a truck, probably has one person answering the phone, probably him answering his phone, doing all the bookings. maybe has his bride or someone else doing, or daughter or son, doing, sitting behind the desk at the office, handling some things. This is a pretty small operation.
Yep.
And the thing that we hear often right now is this, it's almost like this infectious wave of scaling. Oh, you got to scale, you got to scale, you got to scale. Well, the reality is, let's look at it right now. I don't see wages in there. So I'm assuming like right now, this guy,
Payroll.
I'm sorry, you got payroll. Okay. So you got payroll. And realistically, let's say that is split between, a husband and wife, right? And the husband and wife, and there's lots of reasons to take payroll, right? There's lots of really good reasons to take payroll as a business. And, it opens up lots of other opportunities, which is way beyond the scope of this call, but, for 401ks and things like that, which are really, I mean, in terms of the amount that you can put into a business 401k compared to an IRA, night and day. Like it's just off the charts, right? But you still have a net profit of $152,000 in this business, and you still took, just short of $250,000 in payroll. So this guy's probably doing okay, right?
Yep.
So but the thing is that it's so easy to get drunk on the idea of scaling. This guy's nowhere ready for scaling.
Yep.
He may not have the systems, he may not have the psychology in place for that. So that's where I see a lot of this sort of thing where they're trying to hit, they get to 750, they get to 850, they get to 1 million in sales. And then they realize, oh my gosh, I'm making so much less money. I made a lot more money when I was a lot smaller. And that's what you're going to see, that don't get sucked into the scaling trap. You may have a business and it may just be a business of you. That's great. Look for places to channel that money somewhere else. Don't necessarily get hung up on the scaling, the lie of scaling, because it doesn't always make sense to scale.
Yep. And I want to give the audience real quick, big, net profit percentage, right? Let's look at what
true profit margin. Yeah.
What are you, because I mean, look at this, right? Business drops a little bit. We're not talking about a huge drop here, right? Now, if we added zeros behind the sales, that would be a bigger drop, right? We'd be talking almost 6 million down to 5.5. But what is this percentage that you're keeping, right? Because, Mark, you and I both know as you grow a company, as you scale, you are going to lose a little bit of efficiency, most generally, right? At least at certain periods. And so, I mean, if this percentage is, hey, I kept 12% last year, or let's just say for easy round numbers, I kept 10. Do you want to go add $1 million more in work to keep 100 grand?
Yeah.
To me, when my answer to that is hell no, right?
So much sense. Yeah.
For different, there might be some business owners out there that say, oh yeah, I want to do that. But, let's look at this percentage first. Are we efficient? Because if this is the case, do I want to go add $1 million to keep 450,000? Yeah, I think that's a completely different scenario that I'd be open to, right? So let's look at not just the dollars, right? And again, I think as accountants, this is kind of another area where a lot of times we fall short. We just provide statements with dollars, right? And the business owner is looking at this, right?
That's exactly right.
And we don't break it out into percentages enough. Yeah.
Yeah, such a great point. Can you go back to that other screen real quick?
I can.
Yeah, so I kind of went off on a little bit of tangent, and Ryan did a good job of bringing this back in, because I'm sitting here thinking, like, if I'm looking at scaling, now let's say that on year A, you had just shy of $600,000 in revenues, and he had payroll expenses of 176, which was split between maybe he and his bride, or just him, whatever. And his company still kept in the bank $200 and almost $70,000 in profit. That's pretty substantial, right? Like that's a good life. And now let's say he did this working 30 hours a week. And he might say, you know what, I do want to be a little bit busier. I wouldn't mind, working an extra 5-6 hours a week, or maybe 10 hours a week, and working full time, and maybe, handing this off. And if you've got the bandwidth for that, and you're saying, okay, so you're going to look at increasing your efforts by, say, 10%, and by doing that, it's going to increase your sales by, say, 250,000. Okay, now it's a math problem, right? So I love the fact that you brought this up in terms of the gross profit margin. So you've got profit margin, which is the 270,000. but you got your gross profit margin percentage of 45%. And tracking that from 45% from year A to 23, was that 23, 28% in
28.
year B? Yeah. Like that's substantial. You're saying, oh my gosh, like now let's just pretend that in year B, instead of it going down, it went up to 750,000 or a million. And of course, margins are always going to compress. It's the nature of the beast. They're going to compress because think of every time that you sign up for a subscription service, that compresses margins. Every time you sign up for, a new debt or a new payment or whatever, margins compress. And I mean, that means they go down. So this is one of the reasons why I really would encourage, and this is more of a, strategic perspective, which is what I offer, is making sure that when you're starting these businesses out, you're always starting out with very heavy margins and higher pricing. And most business owners don't do it that way. They come in at lower pricing because they want to get volume. And I respect why they're doing it. But the problem is when you go to try to raise your prices later, you don't have proof of concept at that higher price. So now you're like reinventing your business all over again. So this is where you look at like the Tesla model, where they came in at a very high price, right? Versus the Kia model, which came in at a very low price. So think of the difference psychologically between a Tesla and a Kia. Kias are, I mean, if I'm being honest, Kias are decent vehicles, are nice vehicles. I won't ever own one. I won't ever own one. Psychologically, I think they're inferior. And I know that I shouldn't think that way. Will I ever own a Tesla? Probably not. I just don't like that's not my thing. But do I think Tesla is fundamentally a better vehicle than a Kia? Yeah, I do. Right. And that's because of the way they came into the market. So for you, pricing strategy really makes a big difference. And I would really encourage you to look at your pricing. There's no benefit to being the second lowest price in a market. There just isn't. This is where you have to look at pricing strategy, and coming into the market with very heavy margins allows you to have growth later on rather than trying to catch up later on.
Yep. Love that. Love it. And the other thing I'll add there real quick is I think by starting out at higher prices, right, and really proving the model out and proving that you can sell at those prices, that also allows you to test for product market fit, which I think is a whole other conversation you and I could have, but it's really testing your market to see what it'll bear, right?
Yeah.
And so again, I think that's a whole other conversation, but I like that approach that you're giving. So I want to
Yeah, I think it makes a lot of sense for a lot of industries, whether you're a contractor, whether you're you're a coach or a consultant or whatever it is, you always have these marketing, like, again, you may have your main marketing engine driving things, but you've always got stuff that's out there that's testing. And I think that's a great way to test the market.
Yep. So I want to wrap up this income section or income statement section and just kind of highlight in here, I have this example, and we won't talk about depreciation. It's just kind of wonky, but payroll, marketing, and overhead, right? So we talked about payroll. Obviously, we know that that's wages. It's what's going to your team. Marketing is obviously probably not direct paid ads, right? I think if you're getting paid directly for a click, that turns into a, consultation or a, $99 checkup. If you're heating, Henry's Heating and Air, that probably goes in cost of sales. So we're talking, website expenses, SEO, things like that. That would be in marketing. And then your overhead, insurance, think all the stuff to run a brick and mortar, right? Insurance, utilities, rent, right? Printer costs, paper, all office supplies, all those kind of categories are going to go in overhead. And again, just to recap the income statement, and a lot of business owners are probably familiar, but when you start with gross profit, you subtract out these three expense buckets. That's going to bring you down to your net operating profit. And then I do have a line item here that's total other income. That's just other miscellaneous things, right? Other miscellaneous items could be credit card points. If you have a business credit card and you redeem that in for cash, could be interest income. If maybe you charge interest on your clients' bills that don't pay on time on 30 days. It literally is other items that shouldn't be too large most of the time, I would say. But getting down to this net operating profit, again, we've got to take out our three expense buckets.
So and I'm going to throw a little bit of a curveball. Would that be something where you would call that an extraordinary item?
Yeah, I
Okay.
probably would.
Yeah.
Yeah.
So an extraordinary item is not like, wow, that was really great, right? It's not an extraordinary. Extraordinary means that it was a one-time event.
Yep.
So what might happen, let's look at Henry's HVAC. If he sold a van, right? That's not the normal, like let's say he sold a van, he got $5,000 or $6,000 for it because it was just getting to the point where he just needed to get rid of that van, sold the van and got $5,000 or $6,000 for it. And that should be tracked as money in, but not necessarily revenue because it's not related to the ongoing concern or the ongoing operational function. So that's where it would be something related to, would be called an extraordinary item.
Yep. Or another item there that would really align is, let's say you crashed a van and it just totaled the thing out and you got an insurance payout,
Oh,
and,
great. That's, yeah.
and let's just say that you had that van paid off, you owned it. And let's just say that insurance paid out was 20 grand out of this 24,000.
Sure.
That $20,000 goes in as other income for the business. You are going to be taxed on it. I think
Mhm.
that's one of the last things we maybe have to talk about here is you get taxed on your profits
Right.
as a business owner. So, you get that $20,000 insurance payout, you are going to be taxed on it, right? I think a lot of people might not understand that, but when you put it into a business, it goes in other income. Again, it's extraordinary because you're not going to crash a van every year, right? Or at least we hope that you don't.
Ideally not. That does not make a good business plan for sure.
Correct. Correct. So yeah, just want to highlight that point again, right? You get taxed on what your profits are. Now, obviously, if you're on payroll, you're going to get taxed there as well, right? For
Mhm.
getting paid those dollars. But also notice the setup here too, right? If let's just say that this, as you mentioned, let's just say this payroll is for the owner and the wife. These dollars are actually coming out of your profits.
Right.
So you're getting taxed here on these. They are not included again down here in net profits that you're getting taxed on.
Right.
So it is kind of, set up in that way, the right way. But this net profit number is what you're going to be taxed on as a business owner.
Right. Right. And there's, again, beyond the scope of this call for right now, but there's reasons to, I mean, I know a lot of people like, oh my gosh, paying tax, I have to pay taxes on 152,000. Well, here's the thing though, is that I'm a little bit more conservative. I climbed through 2008, 2009, and I got my teeth kicked in by the market because I was way over leveraged, did not have a near enough cash. I will not put myself in that situation again to the point where I will delay paying bills as long as my cash balance is growing because I have to maintain that cash growth. And that cash is what is my insurance policy. That's like if the world truly goes to crap. Now, you can hold cash in lots of different ways. I hold cash in lots of different assets. But the point is, how quickly can I convert those assets to cash, to liquid cash? So that 152,000. So I want to make this, I love that you did this on the balance sheet. So I'm going to have to interpolate this a little bit. So the 268,000 at the year end of 2023 on the balance sheet, you'll notice, look where it is, right? It's at the bottom of the balance sheet of 2023 because it added $268,000 in net profit to the balance sheet, right? To basically to the value of the company. And that's where net profit comes in. So this is really important. Now, when I hear people go, oh my gosh, I paid a huge amount of taxes. The reality is if you're going to keep cash in your business, you're going to have to pay taxes. Now, there's tax advantage ways to do it and everything else. That's a whole other call. But the thing is that I don't get too hung up about paying taxes as long as my cash balance is growing. Because once that cash is in your business, you don't have to worry about paying taxes on it again. Now you're going to be you're going to be growing over through interest and things like that. But that's why I like to have it. I don't get too hung up about paying taxes because I know my cash balance is growing. And that's why now there's ways to offset that by buying things like by buying real estate. That's one of the reasons why I like being in real estate because there's a real tax advantage to owning real estate, which is it basically, if you scroll down just a little bit, and show that depreciation and amortization, that's basically taking the value off of an asset like, like vehicles, like real estate, and it's basically lowering your tax liability. So that's one of the reasons we could talk about that another time in terms of, tax strategy, but buying a building and depreciating that. I mean, that's why I've been able to keep so much cash grow my cash balances, because I've got so much depreciation of my real estate. So just something to consider. And owning real estate may not necessarily be right for you, but that's one of the things that you start looking at, and the more you understand the rules, just like solitaire, just like Monopoly, the more you understand the rules, it allows you to operate at a higher level. But you got to understand the basics first.
Yep. Paying taxes is the penalty for success. That's a little phrase that has been floating around kind of a few of the CFO circles that I'm in right now.
Yep.
Yeah. Paying taxes is the penalty for success. If you have a tax problem, I think that's a good problem to have, Mark, as you're saying, add more cash to the bank, right? The solution is not to go out and buy an $80,000 Cadillac Escalade in cash because you can write the whole thing off, right?
Right.
Bad idea, right? So don't do that. And Mark, maybe you and I can again dive into some of these tax things on another episode. But
sure.
For now, I think we've given everybody enough here. Again, highly recommend the first 20-25 minutes of this where we are going through the balance sheet. Please, go through that as many times as you need to understand it. Reach out to Mark, reach out to me. And this is to be continued. Mark and I, again, as I mentioned at the top of this is going to become a small series. I think we have a whole nother case study to look at with a whole different fictitious company that we're going to get in and highlight some other problems and challenges that this other company is facing. So that's a quick teaser for you. There is going to be a part 2 and beyond. So stay tuned in. And Mark, again, thank you so much for taking the time and coming on the show.
I think we could do this for another hour, but I'm sure people are starting to get a little weary. But to your point, Ryan, this is education. Take the time to really understand it. And the more you understand this sort of stuff, like one of the points that you had made earlier is that your CPAs, your accounting people, they're not going to go through this level of detail with you. And you're like, well, what am I paying them for? Well, you're paying for compliance. You're paying to keep you out of jail, right? You're paying them to keep you legal, but they're not necessarily coming to you. Most of them. Some of them will, but most of them are going to come to you because they've got so many clients and they've got so much volume. They're just going to be like, yep, here you are. You're compliant. Here's your balance sheet. Here's your income statement. Got any questions? Call me, right? But no one really knows the right questions to ask. So I love that we're taking the time to really peel into this. And I'm really looking forward to more future calls. And the next call is actually a company that does have increasing revenues, right?
Yep.
Right. So sure. We're looking at a different problem, which is actually called growing broke. So I'm really excited to peel into that one.
Love it. Well, until next time, everybody, go accelerate your profits. See ya.
Thank you for listening to the Net Profit Podcast with Ryan Kimler. Make sure to subscribe or follow the show on your favorite podcast app. Don't forget to check the show notes for our guest contact information and to connect with Ryan on his website, netprofitcfo.com.